If you've been looking into ULTY, one of the hottest high-yield ETFs from YieldMax, you've probably noticed the payouts look massive. This has made a lot of investors ask the same question. Should I take these dividends as cash or set up a DRIP, a dividend reinvestment plan, and let them compound automatically? That's exactly what we're going to break down in this video. And by the way, quick reminder, this isn't financial advice. Always do your own research before investing. All right, so let's set the stage with ULTY. For those new here, ULTY is the Yield Max Ultra Option Income Strategy, ETF. Unlike some of the other Yield Max funds that are tied to individual companies like Tesla or MicroStrategy, ULTY is diversified. It holds a portfolio of different companies. That means it's not just betting on a single stock, but rather spreading its strategy across a wide range of holdings. On top of that, ULTY's big appeal is its high distribution rate. As of now, it's been paying out dividends on a weekly schedule with eye-catching yields that have put it on a lot of investors' radars. Now, once you receive these distributions, you have a choice. You can either take the money as cash into your account, or you can opt for DRIP, where your broker automatically uses that dividend to buy more shares of ULTY for you. Both have pros and cons, and which one works better really depends on your investing goals and your cash flow needs. Let's start with DRIP. A dividend reinvestment plan might sound like a boring financial tool, but it's actually a powerful concept. Instead of taking a dividend payment and spending it or letting it sit in your account, the money instantly gets converted into more shares of the ETF. And since ULT pays weekly, this means you'd be consistently buying tiny bits of ULT every single week. That can add up over time, especially if the share price stays in the range it's been trading. The advantage of DRIP is compounding. Every new share you get from reinvesting produces its own dividends in the following weeks. It's a snowball effect. Over months and years, you could end up with way more shares than you started with, even if you never add new money. If you're a long-term investor and you don't need the cash right now, DRIP can quietly build your position in a way that's almost effortless. On top of that, DRIP saves you from the temptation of trying to time the market. Think about it. If you take cash, you might sit there wondering whether to reinvest now or wait for a dip. With DRIP, you're dollar-cost averaging every week automatically, without stressing about market timing. But there are some trade-offs. If ULTY's share price trends downward over time, and remember, with option income ETFs, prices can drift down as distributions are paid out, then your reinvested dividends could end up buying shares that keep declining. That's not necessarily bad if you're focused on collecting distributions, but it's something to be aware of. DRIP works best when the ETF you're reinvesting into has long-term stability or potential to hold its value. Now, what about taking the cash? This is the other side of the decision. If you elect to receive dividends as cash, you get those weekly distributions directly deposited into your account balance. The obvious benefit is flexibility. That money is yours to do whatever you want with. You could reinvest it into a different ETF or stock that you believe has more long-term upside. You could hold it as cash if you're building an emergency fund. Or if you're in retirement, you could actually use it as weekly income to cover expenses. Taking the cash is basically choosing liquidity over automatic compounding. You maintain control. Instead of being locked into buying more ULT shares every week, you get to decide where the money goes. That can be really useful if you like to diversify across multiple ETFs, rather than concentrating too much in just one. So, which one is better for ULTY specifically, DRIP or cash? Well, let's think it through in the context of ULTY's characteristics. First, the ETF is designed for high yield, not necessarily long-term price appreciation. That doesn't mean the price won't move up or down with the market, but the strategy itself is all about generating frequent distributions. If you DRIP, you'll accumulate more shares, which means your future distributions could get larger in dollar terms, even if the per-share payout fluctuates. That could be attractive for long-term income maximization. On the other hand, because ULTY's high distributions can lead to share price erosion over time, some investors might prefer taking the cash and redeploying it into other investments that balance growth and income. In other words, reinvesting into ULTY locks you deeper into this high yield strategy, while taking cash lets you spread your risk. Let's look at two investor examples. Imagine investor A is 30 years old, has a steady income, and doesn't need the cash flow. For them, setting up DRIP could make sense. They're focused on building as many income-generating shares as possible for the future, and they're comfortable letting ULTY compound on autopilot. Over 10 years, this could snowball into a much larger share count and bigger weekly distributions. Now consider investor B, who's 60 and using dividends to help cover living expenses in retirement. They'd probably prefer taking the cash. Every week, they can count on distributions hitting their account, and they can spend it without having to sell shares. Even if ULTI's price drifts lower, it doesn't matter as much because they're in it for the cash flow today, not growth tomorrow. Another factor is diversification. If you believe ULT's yield is great, but you don't want to overexpose yourself to one fund, taking cash gives you more control. You could funnel some of those dividends into a growth ETF like VOO, or another high-yield play like JEPI, or even a different yield max fund. That way, your portfolio doesn't live or die based on ULTY alone. Of course, nothing says you have to go all in on one strategy. Some investors do a hybrid approach. They let part of their account DRIP automatically while taking cash in another account. That way, they get some compounding benefits while still keeping liquidity. Depending on your broker, you might even be able to set preferences at the account level or ETF level to customize this. At the end of the day, the better option really comes down to your goals. If you want maximum compounding and don't need liquidity, DRIP is powerful. If you want flexibility and control, taking cash is probably smarter. Neither one is universally better. It's all about what fits your plan. And with ULTY specifically, because of its weekly payouts and high yield structure, it's a really interesting case study for this decision. Weekly DRIP means fast compounding. Weekly cash means steady, predictable income. That's the beauty of having the choice. So, what do you think? Would you rather set up DRIP with ULTY and watch your share count snowball, or take the cash each week and use it however you like? Let me know in the comments. I love hearing how different investors approach this decision. And as always, don't forget, this is Money Stick Unfiltered, where we break down ETFs and dividend strategies in a way that's easy to understand. Make sure you hit that subscribe button if you found this helpful, because we've got a lot more deep dives into high-yield ETFs coming your way.